The dollar is under pressure again, and this time the market may be underestimating what that really means. If the greenback starts to lose momentum, while inflation stays sticky, debt keeps rising, and global confidence keeps cracking at the edges, gold and silver do not just drift higher. They can move violently. And the biggest mistake investors make in moments like this is waiting for the headline confirmation after the move has already happened. Right now, most people are still looking at gold and silver like they are side stories. Nice to own maybe, good for fear maybe, but not urgent, not central, not the main event. That is where the opportunity starts, because when the dollar gets shaky, precious metals stop being a side conversation and start becoming the market's report card on trust. And trust is exactly what is being tested. What is happening here is not just a currency story. It is a credibility story, a debt story, a rate story, a liquidity story. The dollar sits at the center of all of it. When the dollar is strong, it hides weakness across the system. It covers over bad policy. It delays pressure. It gives markets a kind of artificial calm. But when the dollar starts to soften while the structural problems are still unresolved, the mask comes off. That is why this setup matters so much. Because if the dollar is rolling over for the wrong reasons, not because the world is healthy but because confidence is eroding, then gold and silver are no longer reacting to one data point or one central bank speech. They are reacting to a much bigger shift. A shift in how capital protects itself when promises start looking weaker than the assets backing them. And that is where this gets dangerous for anyone still asleep. Most investors think gold rises only when panic is obvious. They wait for a crisis headline. They wait for emergency cuts. They wait for some dramatic event that everybody can point to. But that is usually too late. Gold often begins moving when the market senses that the policy path is narrowing, the debt load is becoming unmanageable, and the currency is losing some of its credibility, even before the full public realizes it. Silver can be even more explosive. Because silver does not just carry monetary energy, it carries industrial demand, volatility, and emotion all at once. When gold starts pulling in defensive capital and silver catches the move, the rally can stop looking orderly very fast. It can start looking like repricing. And repricing is what people miss until it is happening in real time. So let's get clear on the core issue. Why is the dollar under pressure again? It is not one thing. It is several pressure points hitting at the same time. First, the debt problem has not gone away. It has grown louder. Governments can survive with large debt loads for a long time, as long as funding conditions stay manageable, and markets believe the long-term story is still intact. But once rates stay elevated, refinancing gets heavier, deficits remain huge, and growth does not outrun the burden, the conversation changes. The market stops asking whether the debt is large. It starts asking whether the system can carry it without currency debasement, financial repression, or some form of policy retreat. That question alone is bullish for gold. Because gold lives in that zone of doubt. Gold does not need total collapse. It does not need apocalypse. It simply needs enough investors to ask a very uncomfortable question. If the debt cannot be solved honestly, how will it be managed? Then there is the second pressure point. Real confidence in fiat depends on discipline, and discipline is where things get messy. Central banks talk tough when inflation is the threat. Politicians talk tough when deficits are the headline. But the system rarely chooses pain for long. Once funding markets tighten, growth slows, or unemployment rises, the pressure to ease comes back fast. And if the market senses that policymakers will eventually choose relief over discipline, the dollar can weaken before the official pivot even arrives. That is the kind of move metals care about. Because gold and silver do not wait for the ribbon-cutting ceremony on easier money. They front-run it. They begin moving when the market starts believing that the current toughness cannot be maintained forever. And look at how fragile that balance already is. On one side, rates cannot stay painfully high forever without damaging growth, balance sheets, and the refinancing machine. On the other side, rates cannot fall too quickly without risking another inflation wave or another credibility hit to the currency. That is a trap. And trapped policy is usually good news for hard assets. Now add the third layer. Global demand for dollars is still powerful, but it is not untouchable. This is where many people get lazy. They hear that the dollar is the reserve currency and assume that means permanent immunity. But reserve status is not a magic shield against pressure. It is an advantage, yes, a huge one. But even reserve currencies can weaken when debt explodes, alternatives slowly expand, and major nations begin diversifying reserves, trade arrangements, and settlement channels. This does not require the dollar to disappear. That is another mistake people make. They think the only bullish case for gold is a total end of dollar scenario. No. Gold does not need the dollar to die. It just needs the dollar to lose some marginal trust, some momentum, some unquestioned dominance at the edges. That is enough to redirect capital. That is enough to change how central banks buy reserves. That is enough to turn precious metals from optional to strategic. And strategic demand is different from speculative demand. Speculators chase momentum. Strategic buyers build positions because they no longer fully trust the paper system to protect purchasing power over time. That kind of buying is stickier. It does not vanish because of one red day. It does not get shaken out by one hot jobs report or one hawkish interview. It is rooted in a bigger judgment about where the world is heading. That bigger judgment is what the market may be waking up to now, because beneath the daily noise, the macro picture is still deeply unresolved. Inflation may cool in one area and reappear in another. Growth may slow, but spending pressure remains. Yields may move down for a week and then snap back as supply overwhelms demand. Risk assets may celebrate easier conditions, but those same easier conditions may be the very thing that undermines confidence in the currency. That contradiction matters. A lot of people still think a softer dollar automatically means a clean risk-on environment where everything goes up in a comfortable way. But that is not always true. Sometimes a softer dollar is a signal of relief. Other times it is a signal of credibility stress. And when the market starts sensing the second version, gold and silver can break higher, even while the rest of the system sends mixed messages. That is when the move becomes confusing to anyone using old templates. They expect gold to rise only if stocks crash, or silver to rise only if manufacturing booms. Real markets are messier than that. Gold can rally because trust is weakening. Silver can rally because gold is pulling it higher, because industry remains resilient enough, because investor positioning is light, and because the market suddenly realizes metals were mispriced for the environment all along. That repricing can get very sharp, and here is what most people are missing right now. They are focused on nominal stories. Rates up, rates down, CPI hot, CPI cool, payrolls strong, manufacturing weak. Those matter, but the deeper signal is that the system is stretched from multiple directions at once. Too much debt, too much dependence on stable financing, too much political resistance to austerity, too much pressure to keep asset prices supported, too much temptation to solve structural problems with more liquidity later. Gold sees that. Silver feels it a little later, and then often feels it harder. This is why metals rallies can look boring at first and then suddenly stop being boring. The early phase is quiet accumulation. The middle phase is reluctant recognition. The final phase is panic participation. Most people only notice phase 3. They call it irrational. They call it a bubble. But what they are often watching is not irrationality. It is delayed understanding. And the dollar sits at the center of that delayed understanding. If the dollar weakens because the market is pricing in lower real returns, looser policy ahead, and a slower erosion of confidence in fiscal discipline, then gold is not just moving up because of sentiment. It is moving up because the unit being used to measure everything else is losing some of its authority. That is the kind of shift that changes behavior. Central banks diversify more aggressively. Institutional investors rebalance harder. Retail investors who ignored metals for years suddenly feel late. Mining equities, which look dead, start waking up. Physical premiums tighten. And silver, because it is a smaller market with higher volatility, can start doing the thing it is famous for: lagging, 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 and then exploding. When that happens, the move does not feel polite. It feels like the market finally caught up to a story that had been building quietly in plain sight. Now, does this mean gold and silver only go straight up from here? Of course not. These are volatile assets. They breathe hard. They fake out traders. They punish impatience. The dollar can bounce. Yields can spike. Headlines can shake weak hands out. But short-term turbulence does not erase the bigger setup if the underlying pressures remain unresolved. And those pressures are not resolved. Debt is still massive. Deficits are still stubborn. Policymakers are still boxed in. Inflation is still capable of reappearing. Confidence in long-term fiat stability is still not clean. Geopolitical fragmentation is still encouraging reserve diversification. Those are not tiny details. Those are the foundation stones of a bullish metals case. Now think about the psychology here. The market is comfortable when the story is simple. Strong dollar, weak gold. Weak dollar, stronger commodities. Easy. But the real world is now running on overlapping stress points. Debt stress, monetary stress, geopolitical stress, supply stress, policy stress. That means the reactions can become non-linear. Once confidence cracks enough, capital does not rotate gradually. It moves urgently. That urgency is where gold breaks out. That urgency is where silver stops behaving like an afterthought. And one more thing matters here that almost nobody respects enough: positioning. If a market has already become crowded, bullish logic can fail for a while because too many people are leaning the same way. But when a market still carries skepticism, when investors still argue that metals are dead money, that central banks have control, that the dollar will always save the day, the setup is actually more dangerous for the bears. Because under-owned assets can move harder once the narrative changes. Gold has that quality. Silver has it even more. Silver is not just a smaller gold. It is a pressure amplifier. If gold is the calm signal that trust is shifting, silver is the emotional echo of that signal with leverage. It is thinner, less stable, more violent, more frustrating, and when the market really wants it, much harder to catch once it starts running. That is why breakouts in silver matter so much. They usually tell you the market is moving beyond defensive caution and into a broader repricing of monetary stress, inflation risk, and capital rotation. Gold can lead quietly. Silver often confirms loudly. When both begin moving together, the message gets harder to ignore. So what could stop this? A truly credible return to fiscal discipline could slow the metals case. A durable disinflation trend, combined with strong real growth and healthy financing conditions, could reduce urgency. A stronger dollar driven by authentic productivity, cleaner balance sheets, and improving confidence could create headwinds. Those are real possibilities. But that is not the world most investors are looking at. The world they are looking at is one where every solution seems to create a new problem. Keep policy tight and something breaks. Ease too early and inflation or currency pressure comes back. Spend more and debt worsens. Cut hard and growth takes a hit. Defend asset prices and credibility erodes. Protect credibility and markets revolt. That is exactly the kind of environment where gold earns its keep. That is exactly the kind of environment where silver becomes dangerous to ignore. And the hidden risk here is not just missing the upside. It is misunderstanding what the upside would mean. If gold and silver break higher while the dollar is under pressure, the move is not just about metal prices. It is a message from the market that trust in the policy mix is weakening. It is a signal that real assets are being chosen over promises. It is a warning that currency stability may not be as effortless as people assumed. Markets send warnings before the public fully hears them. Gold has a long history of doing that. Silver has a long history of turning those warnings into a stampede. So if you are looking at this setup and thinking maybe this is just another temporary wobble in the dollar, maybe. It could be. But temporary wobbles inside bigger structural weakness can still create major moves. And if the market begins to sense that the path ahead is more debt, more monetization pressure, more policy compromise, and less clean discipline, then gold and silver do not need perfection. They just need the pressure to stay on. And right now, that pressure is back. The dollar is under pressure again. Debt is still rising. Credibility is still fragile. Policy is still boxed in. Capital is still searching for protection. That is not background noise. That is the setup. And if the market starts treating it that way, gold does not just grind, it can break. Silver does not just follow, it can accelerate. That is why this moment matters more than most people think. Because once metals move from interesting to urgent, the price action changes character. The dips get bought faster. The resistance levels matter less. The headlines start chasing the chart. Analysts who ignored the move start explaining it after the fact. And late money, the most emotional money in the market, begins arriving just as the easy part is already gone. That is the real opportunity now. Not chasing after the breakout when everyone is talking about it. Understanding why it could happen before the crowd fully accepts the reason. If the dollar remains under pressure for the wrong reasons, if trust keeps thinning, if the debt burden keeps forcing policy into a narrower and narrower corridor, then gold and silver may not just move higher. They may be preparing for the kind of move that reorders what investors pay attention to for the rest of the cycle. And when that kind of reordering begins, it usually feels obvious only in hindsight. So watch the dollar closely. Watch real yields, watch deficits, watch policy language, watch what central banks do, not just what they say. And above all, watch gold and silver for confirmation, because these two metals have a habit of seeing stress before the headlines make it official. That is the part most people miss. By the time the story feels comfortable, the move is usually already expensive. And if this pressure on the dollar deepens from here, that window may not stay open for long. One reason this matters even more than people realize is the asymmetry. Gold does not need retail mania to work. It can climb on central bank demand, institutional hedging, and a slow loss of confidence in paper purchasing power. Silver, because it is smaller and more emotionally traded, often needs less capital to produce a much louder percentage move. That means, if the macro case strengthens, gold can validate the thesis while silver magnifies it. And once both are moving together, the entire precious metals complex starts attracting attention, from physical buyers, to funds, to mining names that have been ignored for far too long. That chain reaction is how quiet setups become very crowded trades. So here's the question investors need to ask now. Is the dollar experiencing a normal pause, or is the market starting to question the long-term quality of the promises holding the system together? Because the answer to that question could determine whether gold and silver merely rise, or whether they break much higher. If you think this pressure on the dollar is temporary, say temporary. If you think gold and silver are setting up for a much bigger move, say bigger move. And if you want more high-conviction finance breakdowns like this, subscribe now. Because the next phase of this market may reward the people who understood the signal early, not the ones who waited for permission.